If I want to be able to trade Bitcoin or business or real estate, primary home or commercial real estate, and go back into either stock or real estate or business or private equity or private debt or Bitcoin, I want to be able to invest into any asset at any time. So the 1031 doesn't allow you to do that. It has to be investment real estate only into investment real estate.
Welcome, my fellow flow masters, to another episode of the Cash Flow Authority podcast. I'm your host, Chris Jansen, founder of the Flow Authority, and this show is for high-performing professionals who did everything right. You've got the degree, the career, you've got the income, but you just feel like there's another level waiting. And here we explore how real estate can become that next challenge worth building so you can take ownership of your future and really create a life by design. Today's guest is Brett Swarts, and he's founder of Capital Gains Tax Solutions and eXp Commercial Broker. Brett's a best-selling author and tax deferral expert, the tax flow guy, who helps high net worth investors overcome capital gains limitations. So Brett, glad to have you here.
Chris, grateful to be here. Thank you for having me.
You bet, man. You bet. So, so you're a broker, you're a tax deferral expert. It looks like you've handled over $500 million in commercial transactions, which is pretty incredible. What made you kind of pivot from the more traditional real estate broker side to focusing on tax strategies?
Yeah, great question. I think I found that it was in Sacramento, California, when I started at Marcus and Millichap. It was very specific to that city and that product type and that specialty, which is a great place to learn. The challenge became in 2008 when clients faced massive losses due to not having enough liquidity, diversification, and kind of getting trapped in the 1031 exchange that can be painful if you're under the gun. And it really became a way to solve their big problem with that and saying, what could we have done better? And that's when we learned, and I met a gentleman who's one of my business partners who does this tax deferral strategy that we're going to talk about here in a minute, that allows the entrepreneur to be free and flexible and strategic and not put in a box. So if you're in real estate and you're entrepreneurial and you want flexibility to invest, what we're about to talk about, I think, is really going to be a big way to transform the way that you look at selling and exiting and investing.
Awesome. So, so you mentioned the 1031 exchange. I feel like most people, that's what they're familiar with. For me, that's what I'm familiar with when I think about that tax deferral strategy. So what is, what is your strategy? How does that differ? How does that compare? Maybe you can just introduce the topic and we can go from there.
Absolutely. The big problem with a 1031 exchange is you have to buy equal or greater value within a short period of time with equal or greater debt, typically in the same product type, the same place that you're buying in. And the challenge is that real estate takes about 3 years, typically maybe 4 years from the top to the bottom. So if you think about that, just intrinsically, you have 45 days to identify. And if the seller knows that you're in that position, it can put you in a compromised position, meaning you're going to overpay. In an example, in 2021, 22, we felt the market was pretty highly appreciated and we felt like now is the time to get out. But outside of the 1031, the problem is you're typically going to pay capital gains tax if you don't have a good plan in place. So number one, you want to be able to have time on your side. And we believe that timing is the most important aspect of investing, whether that be dollar cost averaging to be able to time things, whether that be waiting for the market to shift. Number two is the ability to have liquidity and be out of debt. We believe that's really important. When you want to have liquidity, you need it. And when you want to be out of debt, you want to be out of debt. And now we do think debt is good when you're leveraged smart debt, when the marketplace is more, let's call it, affordable or valuable to buy. So it's really about making time your friend, and the 1031 exchange just doesn't do that. The second thing the 1031 exchange fails at is it doesn't work for business sales or Bitcoin or stock or primary homes. The strategy we're going to talk about works for all of those. And in fact, we're the first to ever do it with Bitcoin, and we've done mostly business and real estate deals. So if you think about it, if I want to be able to trade Bitcoin or business or real estate, primary home or commercial real estate, and go back into either stock or real estate or business or private equity or private debt or Bitcoin, I want to be able to invest into any asset at any time. So the 1031 doesn't allow you to do that. It has to be investment real estate only into investment real estate. The next thing I'll say is the ability to defer income tax. So to the extent that you have an old depreciation schedule, and a 1031 exchange, the old depreciation schedule is traveling, which is not good. And eventually you need a new fresh depreciation schedule. So with our strategy, you can partner. We use a trust strategy with an installment sale note, partner with the trust to be able to buy investments with the new depreciation schedule, which is pretty awesome. So plus asset protection, plus estate tax elimination. Now, that being said, we do like a 1031 when the deals make sense. And if you can find a good 1031, that's great. We have a best 1031 exit plan. And I don't want to discourage you from going for a 1031, but I want you to be thoughtful about it and have a backup plan in case it fails, so we can save a failing 1031. Or sometimes we do what's called a bifractured 1031. We do a 50% 1031 exchange and 50% of the proceeds into our strategy, which again is a trust with an installment sale.
Wow. Did you come up with this?
No, the tax attorney CPA is really the brilliant person behind this. I just had a chance to study and practice underneath him for a lot of hours. Yeah.
It's just every time I think I know something about the IRS code, then I try to execute it and I learn I know nothing about it. So I'm just like, it's so complicated. It's so complicated, but probably because it's so complicated, there's all these weird loopholes and strategies and things that you can use. Not that yours is a loophole necessarily. I'm just, but it creates all these.
It's a legal loophole, right? I mean, everyone has access to that. Like an IRA is a legal loophole. A 1031 is a legal loophole.
Yeah.
401k. Yeah. So the key is legal. And it goes back real quick on the track record, about 30 years now, a couple thousand transactions, and have been through about 35 audits, all no change, no findings. Most of the deals in California. Yeah. So those are just some of the things that make the track record really solid.
Okay. Awesome. So I mean, you mentioned a lot of things, stocks, crypto, real estate, just moving money around and going from one asset class to another. When I think about crypto, it can create huge wealth, but definitely highly volatile. So how can an investor, cash out of maybe a crypto account tax deferred and move that over to commercial real estate? So kind of the opposite of what you were just talking about.
Yeah, real simple. You're selling Bitcoin or other coin. Step one is to set up a trust with our team. Step two is to sell or assign the coin or transfer the coin to the trust. Step three, the trust sells it to the open market to cash. Step four, the trust issues a promissory note to you for the difference. And so I'll actually tell you a story we did for a client who had Bitcoin. Bitcoin went really high in value and she exited 5 million of the Bitcoin with us. And she was one of the never seller Bitcoiners until she could solve the capital gains tax challenge. And so we helped her solve that. And she was able to use the capital to start a business. It's like a kind of like a self-directed IRA. It's sort of like that once the money's in the trust, where you can partner with the trust to go do your own business ventures or real estate investing. The other amount was just diversified into some stocks that produced some solid gains. That's basically the basis of how this all works.
Okay. Well, okay. Just since you mentioned the self-directed IRA, I mean, with that, they have rules where, I couldn't self-fund my own deal, right? Because they have.
Correct. We have none of those rules. Yeah, we have none of those limitations.
Okay.
Yeah, ours is very flexible, and it can fund your own deals, no problem.
So what kind of trust is this? Is a specific?
Yeah, so there's really two trusts. There's a business trust and there's an irrevocable trust. So the irrevocable version is really set for estate tax elimination is the main focus of that one. It's estate planning with some cap gains and income tax deferral. The other one is a business trust. It's really for the cap gains and the income tax deferral. So I'll give you an example. Let's say it's a $10 million exit, and you've got a 9% interest rate on the note. You can sell for 10 million, defer all the tax, and take 9% interest back, and only pay tax on what you receive in the given year. So the trust is in that scenario, you're helping you defer the tax until you receive payment. So it's known as really just a seller carryback, Chris. So if you've ever done like a seller carryback where you're carrying paper for someone on a real estate sale, that's a way to think about it. The difference is we're not financing the buyer. You're financing the trust. We're asking the buyer to come with all cash, and it's a 3-party sale. And so upon closing, it's like a simultaneous close, and the trust buys and sells for the same price. Therefore, the trust has no gain, and the trust issues a promissory note back to the seller, and the seller just takes installments back and pays tax slowly over time.
Gotcha. Okay. Makes sense. Sorry, my background got all weird, and now, but hey. Good. Now you can see my grandpa's flag and all my cool certificates. So
that's great.
There we go. All right, man. Well, this is a cool strategy. I was going to ask about compliance. You kind of hit on that already, maybe you can talk a little more about that. With when it comes to the IRS. I mean, it
Yeah,
sounds
if
like
there is a challenge on the IRS, there's the lifetime audit defense that's provided, that's built into the strategy. Real quick on the fees, it's like 1.5% of the gross sales price. So let's say it's a $1 million deal, it's like $15,000 to set up. It's only paid at closing if it closes, but it includes lifetime audit defense. So that's important. And then the ongoing fees with the trustee, our role, somewhere around 1.5% to 2%, with the financial advisor, depending on how and where we invest the funds. That's why we like to see deals about $1 million minimum to make this make sense. So if $1 million net proceeds, $1 million gain, you're probably going to pay $2, $3, $4, maybe $500,000 of tax. So we come in and say, do you want to pay, let's say, $400 of tax, or do you want to pay a $15,000 fee, and then let's let the difference, $985, be invested, hopefully earn about 8, 9, 10% net of fees, the recurring fees, and that's kind of the math. And so we want to make sure the deal is big enough, but the lifetime audit defense is built in for every deal.
Yeah. That's great. Yeah, that's crazy. I mean, because it just keeps bumping you up to the tax brackets, right? The more money you make. So, okay, so not all my listeners are probably super knowledgeable necessarily on all the different types of trusts out there. For me, I'm mostly, estate planning, like revocable trusts. So when you say irrevocable, does that trap you into something? Like, does that trap your money there, or are there any, downsides to doing this strategy?
Yeah, so we have two. We have a business trust. That's where 95% of our deals are done. It's a very flexible one. The other one's an irrevocable trust. Yeah, it traps it outside the taxable estate, which if you have above 30 million married to 15 million single, that's a good trap, because you're eliminating the 40% death tax, right, on anything above that. And so that's really important to understand, like what game you're playing. Are you playing the estate tax game, or the capital gains tax game? And the irrevocability is what helps to eliminate the estate tax. Revocability means that you still have ownership, and therefore it's still inside your taxable estate. So it just all depends. Sometimes we'll set up two trusts, Chris, depending on what we're trying to solve for. But think of it like in a Rubik's Cube. Like we're trying to figure out, like, hey, what's Chris's scenario, and how do we get all the colors lined up as we kind of shift and move around to different angles? But that's the main essence. And you're right. A revocable trust is typically for probate, for your living trust, to make sure your assets are passed properly outside of the court system. So we kind of just seamlessly combined or are put into that one. You have like a promissory note. That's a simple answer, but it's once it's set up, it's pretty much set it and forget it, and you just collect payments and pay tax over time.
Okay. So with these strategies, I mean, maybe because I'm just trying to think pros and cons, right? Like maybe a downside. I mean, you weigh them. I don't know if it's even a downside, but instead of getting all the money up front, it's like you're getting paid over time. You're getting paid slowly over time. That's kind of part of the deal,
I mean, the big question is, how to make the deal? How do you make this an investment and not an expense, right? So you really have to know that to the extent that you don't take personal payments, you're deferring all of it. So you can defer all income and all cap gains, all within the trust for at least a couple of years, take no payments, and then just take partial payments is what most people do, and pay small tax along the way. But you might move out of California, New York, New Jersey, and Illinois. You might move to Florida or Texas or Tennessee, where it's a lower tax state, establish a residency, and start taking payments in that state. So that's a nice way to get some arbitrage there. You might want some asset protection, right? You might want truly passive income. We call that no shoes, no shirt, no problem. You're Kenny Chesney on the beach, just receiving cash flow that's durable, that's consistent, that's showing up every month, 20, 30, 40, 50,000 plus a month. And you don't have to trade your time and your energy, the toilets, the trash, the termites for it. That's pretty cool, right? And I can do it in a very tax efficient way and take what I need per month versus all of it all at once and paying this big tax bill. And so that's the game. We call it tax flow, not just cash flow. And so you see my shirt there. That's really what we're in. And it's not just cap gains tax, it's income tax, it's estate tax. And then it's finding ways to be efficient with that money in a way that makes a big impact for you, for your family, for the causes you believe in, with no charity required, no life insurance required, no gifting required, and no seasoning required. We can set this up 30, 60, 90 days before closing. We need to set it up prior to closing. And unless you're using our best 1031 exit plan, then we can do it in combination with the 1031 and we buy a little bit more time. Okay.
So, well, I guess I'm just curious. Do you personally use this strategy, and do you?
Yeah, so I haven't had my large exit yet, but when I do, I absolutely will. And so all my stuff's kind of tied up in investments now. But yeah, when I have an exit, I will for sure.
Okay. And are you still doing the brokerage thing too? Or are you pretty much focused on?
I'm a broker and we refer out, or we're really focused on people that are exiting. We're actually focused on working with brokers, M&A advisors, CPAs, financial advisors to teach and train and become like a wingman alongside of them as they have clients that exit, rather than doing the actual brokerage anymore. We'll just refer that out to the best in the business.
Gotcha. Okay. If you had to give one, the most common estate planning mistake, like one big mistake successful real estate operators make when they're preparing to pass down their portfolio, can you pinpoint one big thing?
Yeah, I'm going to do it depends on their net worth. So if they're above 30 million married or 15 million single, they're not accompanying for the estate tax. Or at least they don't have a great plan for it. Now we do. We can eliminate the estate tax in one sale, one day, but they're playing the wrong game. They're thinking just the stepped up basis is there's no tax upon death. That's only true for capital gains tax. It's not true for the estate tax. So The one big mistake is not playing the right game if you're above that. Now, if you're below that, I would say probably trading what's priceless for what's profitable. We've seen too many people hold on to those deals that otherwise you could get into, free up all of your time. Like if you think about it, the rich dad, poor dad, the fourth quadrant, that's truly passive income. Yeah. That's no shoes, no shirt, no problem. That's just consistent showing up. You don't have to trade your time or energy or anything for it. Yeah. Most people get stuck in quadrant 2 and 3. And so this idea of, I want to get to that fourth quadrant, but then they don't sell, or they just keep 1031ing into the next deal, which just creates more toilets, more trash, more problems. And so there's a Delaware 1031 option that, the challenge with that one is it's no control, no liquidity, no diversification. You're giving all of it up to a third-party group for 7 to 10 years typically, and it's about 5% return. So you got to clarify what really is meaningful for you. And then I have a story for this. A client, Warren and Catherine, they were selling a multifamily property in Sacramento, and we got real clear on it. What was their biggest thing? Well, they had 2 twin daughters at 10 years old that were 10 years old at the time, and then they're going to be 18 in 8 years. And they said, we want to spend as much time as we can with them now. We don't want Warren driving 2, 3, 4 hours back and forth on the traffic and the weekends dealing with the property. Yeah. And by the way, it's not that he didn't have good management or good tenants. He had both. Yeah. He just kept, something comes up. I'm going to go to the property. And it wasn't until they really just sold the property and it was gone, then all of a sudden it frees up this priceless amount of time with his daughter. So like, what are you doing this for? Like, what are you building this $2, $3, $4, $5, $10 million of wealth for if it's just going to consume your time? So get really clear, like, don't trade what's priceless for what's profitable. And then, consider working with us because we can help you sell this asset, defer the tax, but like go in with Chris's deals or go in mobile home parks or industrial or office or multifamily or a real estate debt and get 8, 9, 10+% returned. And when you can double and triple your cash on cash return without any more of your time, what a cool concept, right? That opens up the priceless for just, waiting and keeping the profits. Nice.
I mean, that's so I mean, that, like, for me, that's kind of the long-term goal in my mind is, build up whatever I deem as a sufficient amount of wealth. Right. And then, now let's start to liquidate. Cause I get what you're saying, dude. I use property managers. It's partly, where my properties are located too, but it's just, man, like even just buying a new property right now, I'm going through it and there's just always stuff that comes up and it's such a pain in the ass. It's just ridiculous. And so,
and the states are getting harder and harder to own it, right? Like 20, 30 years ago, even 10 years ago, it was easier to own and be a landlord. But they're just becoming more and more punitive and they don't even care. They just I'll drive out all the entrepreneurs, all the real estate owners out of these states that are highly appreciated. So I'm not sure where you're located, but I know I was from California. Yeah. It's just different. And do you really, just count the cost. Do you want to continue to grind through the tenant right laws and the increased insurance and the hard to get refinance and the higher interest rates and the rent control? And it's fine if you do, but just know there's other options and you don't have to 1031 and you can increase your cash flow. And so we call our explanation the Netflix to the old Blockbuster, right? Now you have to give it some control. I'm a third party unrelated trustee. It's kind of, I guess you could say, one of the downsides. Trustee, you have to work with the trustee. We're kind of like working with a 1031 company or like an IRA company, kind of like that. So there's ongoing fees you have to be aware of, but once you understand that and you're like, oh gosh, there's this better way. And by the way, you can still partner with the trust and go back into your own deal. So we're not saying don't do your deals. We're just saying do your deals on your own term. Like we have some clients that their kids are going to turn 18 in a few years. And guess what? They're going to go right back into real estate. with the trust as their partner to do deals because their kids are in college now, or vice versa, or another scenario, kids graduate college at age 22 and now they want to partner with their kids to do deals. But between 10 and 18, they wanted the time with their kids. Between 18 and 22, they want to do their own deals. And then between kids 22 and 30, they want to partner with their kids. So you need a dynamic capital gains tax strategy and team that flexes with your lifestyle and where you're going. You don't need one that's so rigid that just, you got to grit your teeth to just hold on to this property for the stepped up basis in this 1031, right?
Yeah.
Like that's not abundance, right? That's making a big trade-off.
Yeah. And man, I do a webinar every 2 weeks. Very, very simple, just basic, intro to real estate, right? It's the real estate blueprint. But that's a big piece of what I talk about is active versus passive investing, because most people hear real estate and they just think, oh, it's passive, right? They just automatically assume it's passive. And man, unless you're like just giving your money to somebody else to do the deal and you're completely hands off, and even then, like, what if the deal goes bad? It's going to be a headache. It's going to be a headache. But for the most part, if you're sourcing your own deals, man, even if you use property management, it's active. It's very active. So yeah, lots of good points. So it's great to hear about these other strategies that you can utilize when it comes to, do you want to be passive? Do you want to be active? And then also the estate planning piece. So
correct.
Yeah. Appreciate all the wealth of information, thinking to the future, with tax law is constantly shifting. How should investors rethink their exit strategy over the next few years? Maybe just kind of recap and kind of bundle this all up in a bow.
Yeah, I mean, you might have properties that you can do some cost seg bonus depreciation is back to 100% now, so you might want to look at that scenario. The 1031 seems to be in the clear, at least for now. It was challenged a few years back to maybe be taken away, but with the new administration, it seems like that's just fine. So again, if you have a nice 1031, do it, and you find a nice property that you're not letting the tax tail wag the investment dog, do the deal. Like that's great. Yeah. I think it's also important to just realize that these states that are out of control spenders and our high tax states, they tend to just get worse. We just seen Washington State increased, and they had no state income tax. Now it's at 9.9 if you think you earn above $1 million, but if you sell a deal for above $1 million, they're going to take 9.9. So keep that in mind, like states that are tending to go towards more taxation. And so what does that look like for you and your family and your wealth? We have others that are looking at reestablishing residency in different areas, right? Different locations to lower taxes. So there's certain things you can do. Of course, you probably talk about real estate professional status as well if you have a certain amount of hours. So looking at those scenarios and hiring a really smart team to help you with this. We're here for the exits, and we're happy to work with you at no cost and obligation to see if it's a good fit, as long as you have $1 million net proceeds or better. But work with get a good CPA, good bookkeeping group, and a good group that can strategize with you. I think that's be proactive and intentional, because things are always shifting and kind of moving, and you want to be on the front of it if you want the tax flow to go in your favor. Yeah. Awesome. Well, thanks, Brett. Hey, what's the best way people can reach you, find you? We'll put all this in the show notes, but what's your preferred method? Yeah. Kind of two real places. So you go to brettswarts.com. That's BRETTSWARTS. That has all of my social media, my book. My book right here is called Building a Capital Gains Tax Exit Plan. You can find that on Amazon. We have Kevin Harrington from Shark Tank in the book, and Tony Robbins CPA in the book, and I have a few chapters as well. But it's all about really what we've been talking about today, and building a plan that really suits truly passive income and opens up freedom for you and your family. So check that out on Amazon. And then if you have a live deal, like, hey, Brett, or someone, you're an advisor, go to capitalgainstaxsolutions.com and just schedule a time with one of my team members, and we'll sit down and see if it's a good fit. And those are the main places. Awesome, Brett. Hey, I appreciate your time today, man. Thanks for joining the show, and we'll see you next time. Thanks so much. Thanks for tuning in to this episode of the Cash Flow Authority podcast. We hope the insights shared today help you take the next step toward optimizing your finances and building sustainable wealth. If you enjoyed this conversation, please take a moment to subscribe on your favorite podcast platform and leave us a review. It helps other entrepreneurs and investors discover the show. And don't forget to catch the next episode for more insights. Until then, keep mastering your cash flow.